Optimism for seeing a Fed rate cut in March is dropping significantly, down around 15% from 46% last week, according to the CME FedWatch tool. This comes after the strong jobs report and Federal Reserve Chair Powell's comments. Let's bring in Tiffany Wilding, who is the PIMCO Managing Director and Economist, to discuss what we could see from the Federal Reserve ahead of March. Tiffany, just walk us through your timing, your thesis as to what's this next few months, especially as we continue to think about the upcoming meeting schedule, what they could signal about the pace of some of their cuts.
Yeah, well, all of those are really good questions. And I think as just taking a step back, really what the Fed is trying to balance right now, obviously, is the risk that, maybe the job isn't done, inflation settles somewhere above target, with the risk that they're going to do too much and sort of needlessly weaken the economy. And the data, quite frankly, hasn't really been that useful. Well, obviously the data is useful, but there's been some question that's arisen from the data because on the one hand, we have very strong growth and what we would argue is still tight labor market, although it's eased versus last year. While on the other hand, inflation has come down. So obviously this has been almost a too good to be true kind of experience. And I think the Fed, just wants to be sure that inflation's coming down in a sustainable way. So what does all that mean? Well, we had been arguing that March was probably a little bit too early. Chair Powell confirmed that at the most recent FOMC meeting. We think FOMC officials themselves are looking more like a mid-year, maybe a June timeframe for the first cut. But then after that, their own forecast suggests that every other meeting pace could be likely. But when we look historically, what we found is that in rate cutting cycles that were not coinciding with recession, something like in every meeting pace, is maybe more likely. So maybe they get going a little later, but they start to go, when they do go, they go a little faster than their current projections.
Tiffany, what does all this mean then for the jobs market? Because just looking back at Friday's number, obviously much hotter than what the street had been anticipating, what many economic forecasters have been expecting to see on that print. Will we be able to, or will the Fed be able to orchestrate and pull off this soft landing without causing too much harm to the labor market?
Well, so I think that is really the key question. And obviously the Federal Reserve officials believe that they can, and one of the things that we would just note here is that for the unemployment rate to stay consistent, to stay constant, the neutral level of jobs that the economy can create is about 100K per month. Now we've been creating much more than that, 250, 300K in the fourth quarter. It is well above that. So eventually that kind of job gain should put some downward pressure on the unemployment rate. And that's a hot economy that should result in support of inflation. So I think the Fed really wants to be careful here. I do think you need some weakening in the labor market and labor demand. One of the reasons why we haven't seen the unemployment rate increase as a result, despite the fact that jobs have been strong, is because we've had labor supply that's come back. Some of the folks that maybe took a time out after the pandemic have come back, and obviously immigration has been quite strong this year. But ultimately those factors, they look set to fade. And so we really kind of need some cooling off of the labor market here in our view in order to get inflation sustainably back to target.
Does all the data right now say soft landing or does it say no landing? And what does a no landing look like, Tiffany?
Well, I think it's all a matter of timing, right? The markets are going to trade, economic data, can certainly lead markets to trade one way or the other. I think ultimately our own view is that probably over time, over the long run, no landing is really not an option. Chair Powell has said, that, in not so many words, that he doesn't want to be Arthur Burns. They're not going to stop until they get the job done. And so, that's why they're being very careful here. And as I mentioned, I think that balance, the balance of risks here is that they maybe wait a little bit too long. They're delayed in cutting, but then they have to cut a little bit faster than they're currently projecting. So I think eventually we will get back to 2, but right now the economy looks strong and it looks like maybe the Fed has a little bit more work to do in terms of remaining restrictive.
Tiffany, what's your reading on sectors of the economy like the housing market, which could potentially suffer a bit more if the Fed, in fact, doesn't cut rates until the middle of the year?
Yeah, so the housing market is a little bit tricky in some sense for the Fed, and the reason is because after the 2008 financial crisis, obviously we had a housing boom, we had a big levels of inventories of housing as a result of that. But after the great financial crisis, we just stopped building in the United States, and years of underbuilding have resulted in actually a housing shortage, specifically an affordable housing shortage, which we're dealing with today. And the problem with Fed policy, or the kind of conundrum with Fed policy, is that when you raise rates, real investment, real residential investment, so the supply of housing, you restrict just as much as demand. So, in terms of the longer term housing shortage issue that the U.S. is facing, it's not actually clear that higher interest rates are helping that. And so that could be a little bit of actually an inflationary headwind for the Fed moving forward. Now we do think if rates fall, you will see a pickup in housing activity pretty quickly as a result of that housing shortage. And of course, the Fed, that's not something that the Fed wants either. So housing's a little bit tricky for the Fed right now.
All right, Tiffany Wilding, always great to get your insight. Thanks so much for joining us here this morning. PIMCO's chief economist. Thanks, Tiffany.